Imagine the year is 2008. The world was a different place, filled with optimism and a sense of stability. People were going about their daily lives, unaware of the storm that was about to hit. The world watched in disbelief as financial markets plummeted. Panic gripped investors. The news was filled with images of traders in despair, their faces reflecting the chaos that had taken over the financial world. Retirement dreams seemed to vanish overnight. Elderly couples, who had spent their lives saving for a comfortable future, found themselves facing an uncertain reality. The plans they had meticulously crafted were now in jeopardy. The stock market, once a symbol of prosperity, had become a terrifying roller coaster, and everyone was strapped in for a dizzying drop. The sharp declines were not just numbers on a screen, they represented the hopes and dreams of millions. This period serves as a stark reminder of the stock market's unpredictable nature. Financial advisors were inundated with calls from worried clients, each seeking reassurance and guidance in a time of unprecedented volatility. It's a roller coaster ride, full of exhilarating highs and stomach-churning lows. The market's extreme fluctuations tested the nerves of even the most seasoned investors, making it clear that the financial landscape was anything but stable. For many, the 2008 crisis was a brutal introduction to the reality of market volatility. Headlines screamed of financial doom, and people gathered around televisions, watching the news with bated breath, hoping for a glimmer of good news. It was a stark lesson in the importance of understanding risk and the emotional fortitude needed to weather financial storms. Investors learned that managing their emotions was just as crucial as managing their portfolios. This period underlined a crucial truth. Investing is not just about picking the right stocks. It's about managing your emotions and making sound decisions even when the market seems determined to shake you off. The ability to stay calm and think clearly became invaluable. The 2008 crisis left many investors reeling, questioning the very foundation of their financial strategies. Meetings were held, strategies were reviewed, and tough decisions had to be made in the face of uncertainty. But amidst the turmoil, a fundamental truth re-emerged. Successful investing requires more than just market knowledge. It demands emotional resilience, a long-term perspective, and the ability to navigate uncertainty with a cool head. Those who could maintain their composure and stick to their long-term plans found themselves better positioned to recover and thrive in the aftermath. The investor's chief problem, and even his greatest enemy, is likely to be himself, wrote Benjamin Graham, the father of value investing. Graham's insights into human psychology and its impact on investing have stood the test of time. His teachings emphasize the importance of self-awareness and emotional control in the world of finance. His words ring truer than ever in the face of market volatility. The financial markets are inherently unpredictable, and this unpredictability can trigger a range of emotional responses from investors. Understanding this volatility is crucial for anyone looking to navigate the stock market successfully. When the roller coaster takes a dive, fear can drive us to make irrational decisions, like selling low and buying high, the cardinal sins of investing. These knee-jerk reactions are often fueled by panic and a lack of a clear strategy, leading to significant financial losses. We are emotional beings, and our investment decisions are often clouded by fear and greed. These emotions can lead us astray, causing us to deviate from our long-term investment plans. Recognizing the influence of these emotions is the first step towards making more rational investment choices. When the market is soaring, greed tempts us to chase quick profits, often at the expense of sound judgment. This can result in overconfidence and risky investments that may not align with our overall financial goals. Conversely, when the market plummets, fear can paralyze us, leading to missed opportunities, or worse, panic selling. This fear can be exacerbated by negative news and market speculation, causing us to act against our best interests. The key to surviving the stock market roller coaster, as Graham wisely observed, lies in conquering our inner turmoil. By maintaining a calm and focused mindset, we can better navigate the ups and downs of the market. It's about recognizing our emotional biases and developing a disciplined approach that allows us to make rational decisions regardless of market swings. This discipline involves sticking to a well-thought-out investment plan and not being swayed by short-term market movements. It's about separating our emotions from our investments and sticking to a well-defined strategy. By doing so, we can achieve long-term financial success and avoid the pitfalls of emotional investing. Graham's wisdom reminds us that the greatest challenge in investing is often ourselves, and overcoming this challenge is the key to becoming a successful investor. Market fluctuations are as natural as the changing tides. Just as the ocean's waves rise and fall, so too do the prices of stocks and other financial instruments. This ebb and flow is a fundamental characteristic of markets, reflecting the dynamic nature of the global economy. They are driven by a myriad of factors: economic data, geopolitical events, investor sentiment, and even the weather. For instance, a sudden geopolitical event can send shockwaves through the market, while positive economic data can buoy investor confidence. Weather events, such as hurricanes or droughts, can impact industries and, consequently, market performance. Attempting to predict these fluctuations with pinpoint accuracy is an exercise in futility. Even the most seasoned analysts and investors cannot foresee every twist and turn. The market's complexity and the multitude of influencing factors make precise predictions nearly impossible. Instead, we must accept them as an inherent part of the investment journey. Embracing this reality allows investors to develop strategies that account for volatility, rather than being derailed by it. By maintaining a long-term perspective, one can navigate through the ups and downs with greater ease. Think of the stock market as a vast ocean. Its surface may be turbulent, but its depths hold a different story. The deeper currents represent the underlying trends and fundamentals that drive market behavior over time. On the surface, it's a tumultuous sea, with waves crashing and currents shifting. These surface-level movements can be dramatic and unsettling, often capturing the most attention. But dive deeper, and you'll find a calmer, more predictable environment. Here, the long-term trends and fundamental factors provide a steadier guide for investors. Similarly, focusing on the short-term noise of the market can be disorienting. The constant barrage of news and rapid price changes can lead to stress and hasty decisions. Instead, direct your attention to the long-term trends, the underlying currents that drive sustainable growth. By understanding and focusing on these deeper currents, investors can make more informed and less reactive decisions. The stock market is not a get-rich-quick scheme. It requires patience, discipline, and a long-term view. Quick gains can be enticing, but they often come with high risks. It's a mechanism for participating in the growth of businesses and economies over the long haul. By investing in companies and industries, individuals contribute to and benefit from economic progress. Just as a seasoned sailor navigates choppy waters with a steady hand, an experienced investor remains calm and strategic amidst market volatility. This approach helps in weathering the storms and capitalizing on opportunities. So too must a savvy investor ride the market waves with patience and perspective. By maintaining a balanced outlook and focusing on long-term goals, investors can navigate the market's ups and downs with confidence and resilience. Market history is replete with examples of crashes and subsequent recoveries. The 1929 crash, the dot-com bubble burst, the 2008 financial crisis, all were periods of significant market downturns. Yet, in each instance, the market eventually recovered, surpassing previous highs and rewarding those who remained invested. This is not to say that every market drop is a buying opportunity or that recoveries are instantaneous. However, understanding that market downturns are a normal part of the cycle can help us approach them with less fear and more rationality. When the roller coaster dips, it's not a sign to jump off. It's a chance to potentially buy at a discount, provided your investment thesis remains sound. Remember, as with any roller coaster, what goes down must come up. The stock market has an impressive track record of resilience. By understanding its historical rhythm, we can position ourselves to not only weather the storms, but also potentially benefit from them. Don't miss out on more insider tips. Subscribe now and stay ahead in the stock market game.